friends, welcome back. In this session, we are going to discuss about open interest analysis and FNO lot size. Guys, as you know, that open interest is one of the important part of the derivatives studies. And in this session, we'll try to learn all the practical understanding of the open interest analysis. So here we go. So friends, as you know, my name is Chandan Taparia, MBA Finance, PGPBM Finance and Marketing. Having the experience of more than 1 decade in the Indian derivatives market, regular appearance on all the business channel including CNBC TV 18, CNBC Awaaz, Zee Business, ET Now, regular writer and author for most of the derivatives and technical column, mainly in Money Control, Zee Media, ET Online, also writing for leading newspaper including Economic Times, Business Standard, Financial Express, etc. So again here I would like to share my experience that how exactly I learned the open interest and how we can use this indicator to predict the market movement or the stock specific action. So guys, first let's understand what is the open interest. The open interest is the total number of outstanding contracts that are held at the end of each day. When you talk about the open interest, that means the position which is still open yet not settled. You must be knowing that in our Indian markets, we have 3 contract months, current month, next month, the far month. And we have settlement on every Thursday. So every Thursday of the month, the current contract expires and then we have the new more contract. So the next one will be the current month and then next month and the far month. So just for an example, we have October. So last Thursday of the October contract will settle. Right now we are having November and December. So after the ending of the October, the January new 2021 contract will come into the existence. Now we need to understand that when someone is buying and selling, people are having their interest into that positions. We need to understand that what is the flow of that positions. First, it should be clear the open interest will happen when someone is buying and someone is selling. And this open interest is being calculated on one side. Open interests are total from one side, either buyer or seller, and note the sum of both. The open interest is somewhat similar to what we call a delivery volume in the case market. Just for an example, usually we say that particular XYZ company has seen the strong momentum. The volume was 5 times more than the regular volumes, and the deliverable volume were more than 70 to 80%, while the normal deliverable volume for the counter was 30%. So which indicates that there is higher activities, higher participation, higher volumes, and along with that, people are really carrying the position into their demat account, and that's why the delivery volume is high. So when the particular stock is moving up, volume is also rising, and delivery volume is also increasing. We are getting more conviction that particular stock is likely to move ahead, because participants might be taking the positions with the view for positional point of view. When we talk about the volume, you don't know whether the people have bought and sold and they must have exited during the day because of the volatility. But deliverable volume means people are really taking the position into their demat account. However, they may sell it after a few days. But what we understand that if someone has really taken the overnight risk, he might be having the particular view on the counter. Now talking about the open interest, so open interest is somewhat similar to what the deliverable volume is called into the cash market. So we'll discuss in detail length to the open interest, and we'll also understand how to learn the open interest to predict the positive or the negative momentum of the counter. So if I just move ahead, the open interest suggests a couple of things, and we need to combine the open interest volume and the price to come the conclusion. So when I talk about the open interest, it increases when traders open trades, decreases when traders closes trades. A running total of all the open position in the future contract is taken care of. It indicates the cash flowing in and out of the market. While talking about the volumes, increases every time when a trade is open or closed. Running total of all transaction for future contract is taken care of. So we will also understand what is the difference between the volume and the open interest. And in a couple of examples, I'll try to explain what is the role of the volume and what is the role of the open interest. Why we are talking about the open interest? Because derivatives is a zero-sum game. If someone is gaining, the other person has to lose, or vice versa. Because it's a zero-sum game. When someone is buying, other is selling, and as per the settlement or as per the exiting position in between, the debit and credit will be happen. One party will win, other party will lose. So many people raise the questions that how to know that open interest is for the positive side or the negative side. So for that we combine the price movement to understand the money flow of the market.
Register for our free webinar. Download our app today. Link in description.